Hello and welcome to The Rest is Money with me, Robert Peston. Steph is away fighting crime as host of Crime Watch. We're already assured by that, but I'm delighted to be joined by Karen Ward, who is the Chief Strategist for JP Morgan Asset Management Europe, a regular on this programme. So much to talk to you about, Karen. How is the Chancellor going to fill the fiscal black hole? Is she rebuilding the lost confidence of lenders to the UK government? Are we facing a looming financial crisis? I thought we'd start, since we're recording as we've seen inflation figures a bit better than the Bank of England was expecting, a bit better than most forecasters were expecting. Markets have reacted in a positive sense if you are a borrower, because before this morning's inflation figures, markets were broadly discounting no interest rate cut till next year by the Bank of England. There now appears to be a way better than evens chance, markets think, of the Bank of England cutting interest rates in November. Do you think that's right? Do you think if somebody's got a bit of a debt in the UK that they can be hopeful that the bank will cut another quarter point off the bank rate in November?
It certainly could happen. I mean, the bank has been in this really tricky position where the growth side of the economy has been increasingly worrying, particularly the labour market, that companies aren't employing at the rate they were, if anything, returning towards some job cuts. And in normal times, that would be when the Bank of England would spring to action and provide those rate cuts and try and get some activity going and stop the decline. But the bank has been stuck because inflation has been so sticky, has been well above its target for some time. And I think the bank has become increasingly concerned that, we've all got used to higher inflation. And I think there is an element of that. I don't know about you, but every time I open a bill and my annual charge hasn't gone up by 10%, I feel quite chuffed. So we've all sort of got used.
I paid an insurance bill recently and my goodness, that was expensive.
And I think that's a real problem for a central bank. When we all get used to, 2 was the normal increase each year, and we all get used to a number that's more like 4 or 5. That's what economists call de-anchoring. We adjust to a higher level, and that's really dangerous territory for a central bank. So they've been getting very nervous, having to remain with interest rates quite high, talk quite hawkishly about their determination to bring it down. So this morning's news is helpful. Now, let's not forget, it's still 3.8, which is still almost twice their target. So those mortgage holders, I wouldn't sort of spend too much just yet, because we're probably only talking about a quarter point if we do get one, and we need to see some signs that it's easing. But I think every step in the right direction is certainly very helpful.
And before we get on to the nightmare for the Chancellor of a budget where she's going to have to raise taxes very significantly, where are you now on where interest rates in the UK will settle? Because there is definitely a disagreement, including, I think, between members of the Bank of England's Monetary Policy Committee, which is the body that set interest rates, about, essentially where the neutral rate of interest, this is the sort of rate of interest that we can expect to prevail for years and years and years, the sort of non-inflationary interest rate. Do you think that's 3%, or do you think it's nearer 4%?
Probably somewhere between the two. I mean, the way we tend to think about that is to think, what is our inflation target? And then what is our potential rate of growth in the economy? So if we take the inflation target of 2, our potential growth of probably 1.5, that's where nominal growth should settle. Therefore, nominal interest rate should be somewhere around about there. So we're still some way above that. So we should still, over time, see those interest rates come down. But obviously, I built up that number starting with 2. And therefore, for inflation, and the longer we stay with inflation proving sticky, then it's going to be much longer before we can actually get to that number of 3.5.
And the important point, if you are a borrower in the UK, is those years that many people live through of almost 0% interest rates, just forget them. They've gone forever.
Oh, absolutely. And I think maybe for your listeners as well, the other really important thing is to remember to take inflation off of the interest rate you're getting from your bank when you're thinking about what to do with your money. We know we've got all these additional savings in the UK. We spoke about that the last time I was in. An awful lot of them are sat in cash, and I think that's because people are going, oh, this interest rate's much higher than it's been before. Isn't that lovely? But they're forgetting to take inflation and the corrosive impact that has on purchasing power off of that interest rate, which is then what takes you down to about zero return on those cash savings.
So let's get straight on to the budget hole, which is anything between, 30 billion and 50 billion pounds. It's an awful lot of money that the Chancellor has to find at the budget, which will be at the end of next month. The Treasury has made it clear that the lion's share of that will come from tax rises. We can talk about whether there is any scope to squeeze spending, but it's very difficult to see, given their political commitments, what they do on the spending side. We've seen a couple of stories which inevitably happen in the run-up to a budget about possible tax changes in the last couple of days. So the FT did a story saying she's thinking of cutting the VAT imposed on our energy bills, currently a 5% charge, to nil, because she's acutely aware of sort of cost of living pressures. To be clear, though, one of the things that is sort of slightly amusing about that story is, of course, that is cutting taxes, that's giving money away, that is not filling the 30 to 50 billion hole. But let's just start with that. Obviously, there is an issue around people feeling that energy isn't affordable. It's a huge political issue. One of the reasons why some would say, Reform have been doing quite well is because they've been running with this campaign for some time now, that somehow the government's net zero policies is adding to people's bills in a completely unsustainable way. And plainly, we have a government that wants to respond to that. But if you are going to tackle cost of living issues, is that a rational way to do it? Abolish? I mean, you could argue, and I think most economists would argue, that one of the problems with our VAT system is that there are too many exemptions, and energy is one of them. So would it be a good idea to reduce or to eliminate that 5% VAT charge?
Well, I think one of the broader points you make in this comment, Robert, is we have to think about whatever the tax or the spend move is, what are the ramifications of that might make it helpful or actually counterproductive? Because if we reflect back on this time last year and the last autumn's budget, the Chancellor made a great effort to raise taxes. Of course, very difficult decision to raise national insurance contributions. And the hope was that that was going to be the once in a parliament tax rise, the once in a parliament reset to balance the books. But what we learned is even though she was raising taxes, then it pushed up cost pressures for companies, it raised inflationary pressures. That's meant the Bank of England's held interest rates higher. That's fed through to her borrowing costs. So her efforts to raise money, as we look back, probably look a little bit counterproductive. So it can be the case sometimes that cutting taxes raises your overall tax revenue. And I think anything she can do to take the Bank of England out of this bind that we've just discussed, anything she can do to dislodge us from this 3 number back towards a 2 number.
But I want to sort of, in a sense, slightly press you on that, because the history of the Bank of England is it tends to look through, whether it's a one-off rise or a one-off cut. And I think there will be members of the MPC who will say, OK, so, in the short term, the inflation rate is coming down, but not in an underlying sense. I mean, that's just a one-off cut in prices. But in terms of inflationary, you could argue, let's just say it increased confidence within the economy and spending went up against an economy where there isn't a lot of spare capacity. There would be some who might argue doing that would actually be inflationary in the medium term.
So I see that argument, but I do think the bank are really concerned that people have just got so used to inflation being high. That's why they then go into their wage bargaining rounds every year and say, well, I need 4 because inflation's 4. And so we're sort of locked in this high inflation world.
So if you cut energy prices and people think, oh, that's good news, I've got more money to spend on other things, I don't need such a high pay rise, as it were, you think that's how the Bank of England would analyse it. And so the Chancellor would be rational to do something like that.
I absolutely think anything she can do to ease the inflationary pressure is going to free up the Bank of England to provide her a bit of help.
So that is £2.5–3 billion worth spending. All right, but we've still got to fill that hole, right? So at least that little hole might be filled by this other tax change which has been floated. This one's in the Times, and I understand this is absolutely what the Treasury is looking at, which is to end the exemption on employers' national insurance contributions for trade setups which are known as limited liability partnerships. So many law firms are limited liability partnerships. Hedge funds are. Private equity funds are. Quite a lot of accountancy firms are. And these consist of very highly paid people. These are mostly people who work for these firms, particularly if they're senior, are in the sort of top 1%, sometimes in the top 0.1% of earners in the UK. And, for some time, sort of tax experts have said this is an anomaly. It's ridiculous that we get effectively less tax from these people because they do not pay employers' national insurance simply because of what is effectively a corporate structure. The thing that makes this complicated politically for the government, most GPs are in partnerships, and some are in limited liability partnerships. But as I understand it, and this is certainly what the Treasury seems to believe, most are in general partnerships. And as I understand it, what the Treasury is looking at is somehow imposing national insurance for employers on limited liability partnerships, but not on general partnerships, because, first of all, there are quite a lot of firms where the individuals are paid an enormous amount of money that are general partnerships. So, for example, Slaughters, which is, some would say, the leading UK Magic Circle law firm, that is a general partnership. Is it fair that it would continue not to pay employers' national insurance just because it happens to be a general partnership rather than a limited liability partnership? But there is another point. I am reliably told by a guest on this programme, Dan Needle, a great tax expert. He says that if they just do limited liability partnerships and not general partnerships, all that will happen is all the limited liability partnerships will convert to general partnerships and they won't raise any additional national insurance. But the general point, which certainly somebody like Dan Needle has been arguing for ages, is it is a crazy anomaly that these very highly paid people, basically their firms, avoid paying a very significant chunk of tax simply because of the structure.
Well, this is sort of taking me back to my very brief stint in government when I was supporting Philip Hammond, because, of course, then we tried in one budget to adjust the tax system. This was with regards to self-employed and this issue as well, making sure that national insurance was paid by a broader swathe of the population. Of course, it was politically very challenging.
Was this the white van man?
And there was a climb down, yes.
Because I seem to remember the front page of at least one tabloid had white vans on it.
Yes,
maybe more
possibly
than
the longest 48 hours of my life, I should say.
So talk me through that.
So, I mean, basically, the argument around, you're absolutely right. In the big picture sense, we have a tax system that makes it beneficial to structure yourself in a different way. Now, that might be via these partnerships, and it might be perhaps via a self-employed mechanism, or employing people on a self-employed basis when they are actually really employed by one employer, for example. Now, the argument that's always used is one of two things. Either these are risk takers in the economy. These are the people who create jobs in the economy, and therefore they should get a sort of subsidy for doing so. Or alternatively, well, maybe these individuals don't get let's say sickness pay or maternity leave or things that employed in regular structures that they get. And for that reason, they should therefore pay lower taxes. I don't find either argument compelling, to be honest, Robert. If you're a risk taker and risk generator, wonderful. Thank you for doing that service in our economy. But your profitability that the nation affords you as you're taking that risk and growing your business should be how you're rewarded. And in terms of, well, if you don't get the sick pay or the maternity pay, yes, again, absolutely right. You should be rewarded for that. But it should come from the person who's paying for your services, your contractor, rather than the state. The state's relationship with everybody should be, what are you going to take out of the state? What are your children going to go to school? Are you going to get a state pension? Are you going to use the NHS? And I believe that every individual on the same playing field, if you're taking out of the state on the basic public services and provision, which we all do, then you should be contributing the same.
So you're basically saying there should be fewer exemptions and a simpler system.
Yes.
Now, let's go, though, away from the micro, because let's be frank, we're really only talking about 2 to 3 billion from what may turn out to be a very controversial tax reform, to the bigger picture, which is, if she's got a raise between 30 and 50 billion, can she do it from other taxes without actually ending up damaging quite important bits of the economy?
Well, that is the risk, isn't it? I mean, when you're constantly sort of fiddling, if we think effectively, it's a little bit like, if you go to the smaller taxes, you have to lean on them all the harder in order to squeeze the same juice out of them. Yeah. And therefore, the damage you can potentially do via that is, I think, where we run into real problems. I mean, we've seen, for example, ahead of the last budget and happening as well today, people desperately worried about wealth taxes and capital gains. And therefore, right, let me liquidate all of my assets so that I can't be subject to these taxes. And then we have all these people citing cash.
Are people actually doing that now, increasing their cash?
We've seen this as a problem for the last year, this fear of capital gains taxes, wealth taxes. Quick, I need to store my money under the mattress. Now, that's the worst thing we can do because, of course, not only are those individuals harming their retirement prospects and making them even more dependent on the state, we're not providing the lifeblood to the economy. So I think it's absolutely true. If we're going to do this sensibly, it has to be a recognition. It's got to be a small amount on a broad-based tax. But, Robert, I wouldn't mind sort of just because I'm increasingly frustrated with this fixation on the correction has to come from tax. And This is what's frustrating me about this broad conversation and lack of conversation in the nation, actually, because some numbers for you. Yeah. Spending, so government spending as a percent of GDP in 2000 was 35%. So of all the income the UK economy generates, the government would take some of that and spend 35% of it. Today, that number has climbed up to 44% of GDP. Let's fast forward 50 years, and that number has reached almost 60% of GDP.
And that's largely because of the ageing of the population, that forecast of 60%.
That is. The growth up to now is really not being helped, of course, by the number of people that are not working because they are long-term sick. So we've got this real problem structurally here in the UK between the number of people taking out of the public purse is growing much more rapidly than the number of people paying into it. And until we're willing to really have that conversation about how do we stop spending rising to 58% of GDP, how are we going to keep a lid on our pension bill? Therefore, we need to talk about the triple lock, which is grossly inequitable. How are we going to make sure that our NHS provides some productivity improvements so that we're not just adding tens of billions to the pot every single year? How are we going to make sure the long-term sick are back in employment? Until we're really willing to say, let's get spending under control, we are going to be stuck year after year of having a conversation about which tax goes up this year. And that's where I'm immensely frustrated about the current dialogue. We're not having the conversation about how are we going to get spending under control. And in fairness to the front bench, in fairness to Prime Minister Keir Starmer, in fairness to Chancellor Rachel Reeves, they've had a bit of a go at this. They've said, look, our welfare system really needs some reform. The backbench have not supported them. So I don't think this is just that the government are burying their head in the sand. I think they've had a go at this. They can't get the party behind them. But this is where I become worried about the outlook for the UK, because until as a nation we're willing to have a conversation about how we're going to get spending under control, we're going to keep coming back to what tax this time. And I genuinely believe, the tax burden, so let's, it's 37%. So I gave you the numbers on spending. Now on the tax receipts, at the beginning of this century, we withdrew 37% of all the income from the economy in tax. That number has now risen to 41%. And I believe the economy is already showing tax exhaustion. We saw, for example, when George Osborne took the higher rate of income tax, he took it down even though he was conducting a period of significant austerity. And when he took that top rate of tax down, the actual tax take went up because more people came to the UK and paid those higher rates of tax. I'm really worried that until we can have a better conversation about getting spending under control, I think it's going to be an annual discussion on which tax is, and that makes me, I think, deeply pessimistic.
So I should point out to listeners that actually, as luck would have it, our next episode will be a chat with Art Laffer, who is the economist most closely associated with the idea that when you push tax rates above a certain level, you actually get less tax revenue. And there are times when you cut taxes that you can actually generate increasing revenue. For now, though, let's go to a quick break. And after it, Cam, what I want to ask you about is this whole issue of how much the Chancellor's hands are tied by the growing unease among the big investors who lend to the UK. Big stuff to talk about after the break.
This episode is brought to you by Google. Now, if you ran a small business, what would you do with an extra 3 weeks a year? That's how much time the average small business could save with AI, according to Google's latest aiworks report. 3 weeks isn't spare time, it's the ability to get the day-to-day done faster, giving you time to plan for the future. So why aren't more people using AI? Google's research found it's mainly a lack of training and confidence. That's why they launched aiworks, a people-first training pilot that helps small business workers understand how they can use AI tools like Google Gemini to do more. In a matter of hours, people were using AI as a super assistant, instantly unlocking productivity gains. They were using it to write documents, crunch numbers, brainstorm, and even role-play new business ideas. If every SME in the UK gained those 3 weeks, that's a serious lift to job satisfaction, innovation, and national productivity. Just one example of how Google's AI is fueling growth and transformation. Find out more at goo.gle/aiworks.
One of the things that I have been struck by in recent weeks is the extent to which the scope for manoeuvre that the Treasury has to, make, whether it's rational tax reforms, because quite a lot of rational tax reforms would cost you money in the short term, even if it increases revenue over the long term. And they are terrified of increasing the deficit in the short term. And the reason they're terrified of increasing the deficit in the short term is, they are already paying an absolute colossal amount of money in interest on their debt every year. The government is paying well over 100 billion a year in interest on its debts. And they're terrified about that debt burden rising further. How much of a binding constraint on the British government is the fact that we've got, on most conventional measure, debt as a share of GDP 100%, yields, that's effectively the interest rate that the government pays on its borrowing, at really high levels. Now, they've come down a bit in the last few weeks. Gilt prices have risen a bit. When gilt prices rise, just so that listeners know, when gilt prices rise, the effective interest rate paid by the government falls a bit. Where are we in terms of the confidence of investors in the UK?
Well, I think we've certainly seen this risk premium, if you like, between gilts and some of our counterparts elsewhere in the world, the US, for example, or Germany, it's certainly risen here in the UK, which tells you that investors are just a bit more nervous about where we are.
About lending to the government.
About lending to the UK government. Now, I think the Chancellor could probably say, well, that feels unfair because the US doesn't seem to have a fiscal plan at all. They have debt rising forevermore. They're not even trying. Germany's just announced a massive spending plan. So I suspect the Chancellor feels it all seems a bit unfair. But what has happened and what's happening in investors' mind over the course of the year? I think it is a little concern creeping in about what this Labour government's broad direction of travel is. I think, the Labour government came in and Prime Minister Keir Starmer, very business friendly, a huge growth narrative. We are going to focus on growth. We're going to grow our way out of debt. We're going to be pretty business friendly. We're going to do all this planning reform. We're going to get productivity back. We're going to be growth friendly. And they tried to make a few difficult fiscal choices to allow them to focus on growth. They tried to, of course, remove some of the winter fuel payments on certain higher income pensioners. They tried to put together the welfare reform, and the backbench forced the U-turn on both of those. And I think what's happening in global investors' mind is just perhaps a little bit of a reevaluation of, even if the front bench are reasonably centrist, business-focused.
And even if they've got an enormous majority in the House of Commons.
It doesn't necessarily mean you can get things done if the mindset of your backbench is not behind you. So I think that is what has crept in. It's not really, investors are more sophisticated than just thinking about what is the deficit this year? What is the headroom? All of the minutiae conversation we're having here in the UK. Investors just want to see, does a government have a credible plan, and can they explain to their electorate that there are some tough choices to be made and they're willing to do them and stick to them? And this comes back to the conversation I have about what does make me nervous is that the problem we have is on the spending side. And until we're really willing, until they can show that they can make some really tough choices on how they're going to restrain spending, the market's going to, I think, remain skeptical, because we know that we're just going to keep coming back to the conversation of which taxes are we raising this year.
And plainly, as you say, setting out a long-term path is terribly important. And what people shouldn't forget is, we may be the fifth or sixth largest economy in the world, but frankly, we are a pretty small boat in an enormous ocean. And if you want to get a sense of how vulnerable we are, it's pretty easy to make the case that France's fiscal position, certainly in terms of the direction of travel, is worse than ours, but it pays way lower. The government there pays way lower interest rates. And the reason for that is because it's part of the Eurozone, and there's a broad view that if it came to the crunch, the most powerful economy in the Eurozone, Germany, would never let France fail. So they have a very important partner there. We're on our own, right? We left the European Union and we are on our own, which means that there's, for all the sort of, oh my God, it's great, we've got all this freedom. Actually, the problem with freedom is you've then got to use it responsibly. And one of the reasons we're paying such a big premium to borrow is because we're on our own and we're not part of the European Union anymore.
Absolutely. I mean, I've sort of alluded to the fact I think we're slightly burying our heads in the sand of what our real problem is. You could argue that France is much more so. They've just voted down. The government has been voted down because they've been trying to push through asking people to retire after 62. And the French population have said, no, that doesn't sound much fun. We don't want to do that. And so the government said, OK, fine, fair enough. We'll park that idea. Why aren't they, therefore, having to borrow at much higher interest rates? As you say, the assumption that, well, whether it's Germany or whether it's EU bonds at the end of the day, somehow they will get help because they are too big to fail in that project. And we are no longer in the project.
I mean, one of the things that is quite interesting on that basis is you will have seen for the very first time, I don't know in how long, Rachel Reeves saying very explicitly one of the reasons growth is so low in the UK, one of the reasons why tax revenues are not coming in at the rates that they would like is because of Brexit, because we left the European Union. Now, that is not something that this government has had the guts to say, even though pretty much every member of this government opposed leaving the European Union. Now, it raises two interesting questions. One is, when we get this new Office for Budget Responsibility assessment of why the economy is growing so much less, why productivity is so disappointing, it'll be very interesting to see if that includes a much bigger estimate of the cost to the UK of leaving the EU. The OBR's current estimate is that it's reduced GDP, national income, by about 4%. Quite interesting to see if they then say, actually, the cost has been is going to be rather bigger than that. And then if that actually kickstarts a slightly different national debate about what kind of relationship we should have with the EU. Because the big politics, when I talk to investors in the UK, there is a sort of fairly widespread view that if the government was able to set out a coherent path to what would look like membership of the European single market, that would immediately increase optimism about the growth prospects of the UK. And then you would then get into a virtuous circle of more money coming into the UK, almost certainly lower rates for the government when it comes to borrowing, which then would reinforce a rather higher growth rate. It's too early to say whether what the Chancellor is doing is trying to simply make an excuse and blame her predecessor, or whether this is the beginning of a rather bolder proposal or bolder plan by the government to get closer to the EU. What do you think they should do on that?
I think they are already demonstrating. The need for the continent broadly, regardless of which exact club you're in, to work together on defence, to defend our continent in the face of Russia's aggression against Ukraine, I think has provided the momentum for the UK to at least be able to rejoin some of the conversations, which is very encouraging. And I think you're absolutely right, Robert. If we can then use that conversation to say, right, having voted leave, having gone through the experience of it, what parts are really benefiting us of our sudden autonomy and sovereignty, and what parts maybe do we want to renegotiate and try and create a better relationship. And I think certainly at least being able to allow goods and services to flow across borders more easily, yes, okay, we'd have to more clearly align with regulatory standards, but is that a big, I've always questioned when people voted leave, was that the big thing that they cared about, whether we had the same sort of regulatory standards?
Since we've left, no regulatory reform has taken place that has significantly increased our growth rate. So even if that was a golden opportunity, it's been squandered.
No, I can tell you from my own industry's experience that having our own autonomy and sovereignty, and therefore a regulation that you've got to comply with to operate in one jurisdiction being very marginally tweaked is not remotely helpful in terms of actually freeing up. It's actually just expanded paperwork and the things you have to do. So I think we're seeing them already create a more constructive discussion with the EU. And yes, I do think that is a direction that may continue and should be helpful. What we do know is business investment here in the UK fell in 2016, and that, although it's recovered a little bit since, the level of investment, the sort of investment foregone through that period is still very significant. And if companies are not investing, then we don't get productivity, and that brings us all back to the Chancellor's big problem.
Now, there's one other potential sort of negative on the horizon that the Bank of England has flagged up. They made a warning about the so-called private credit market. Now, this is a way of providing loans to businesses outside of the banking system. It has grown very significantly since the global financial crisis of 2008, when capital requirements for banks were put up. And one of the reasons for the Bank of England's warning is we did see two quite small businesses in the States getting into very serious trouble as a result of their debts on the private credit on the private credit market. Is this a sort of, mega accident that's about to happen? The Bank of England says there are aspects of this that are similar to the kind of crazy risk-taking that we saw before the global financial crisis of 2007-8. Are they over-egging it? What's your view?
So there's no doubt that, as you say, the reasons for this all started from the financial crisis, much more regulation of the commercial banks, and therefore that tends to always result in lending that happens outside of traditional banking. And it's often called shadow banking. And I think that very term, shadow banking, sort of creates that sense, doesn't it, of, oh gosh, it's stuff that's happening in the dark. It must all be dodgy and bad companies taking on bad loans that they're never going to repay. I don't think that is the case. I think that, a lot of, because we've seen not only massive growth in private credit, we've seen massive growth in private equity. We're generally seeing companies not coming to the public markets. They're staying private. And I think that is because they are, life is easier. They don't have the same regulatory burden, the same disclosures. And therefore, that's, reasons really why we've seen the growth. We don't think this is all dodgy, low quality companies, and this is all about to end in tears.
One of the advantages of public markets is typically there is more data, so that if you're an investor or a regulator, you have greater visibility of the risks that are in the system. The sort of definitionally, once you're in that private space, there is much less disclosure of what risks are really being taken, which is why, many of us would be a bit uneasy about it.
I understand that completely. But, the people lending to these, we've sort of substituted, if we think about the supplier of the money as such, they have to do the due diligence themselves rather than it necessarily happen via regulatory quarterly account disclosures. So many big institutions, many of the big providers of public capital or big listed names, they will have their own process of due diligence. I think that what's actually really happening at play here, Robert, is not so much a private credit question. It's that we have moved from a world of very low interest rates to a world of much more normal or higher interest rates. And there will be businesses, and in some ways I'm sort of surprised it's taken so long. We know there are going to be many businesses whose business model is much more challenged in an environment where their interest rates are 3 to 4% higher. And so as companies are rolling off those low-cost loans, whether they would have been in the commercial banks and are now in private credit, they are just encountering the shock of making the numbers add up. And so we will see more problems in this space. And this is higher risk lending. So, you charge these individuals more this in private credit because they are higher risk. This is not investment grade companies. These are higher risk companies. So you would expect a number of them to be defaulting regularly anyway. They're in the higher risk space. But your big question is this going to become systemic? Is this going to be enough of a credit event which will infect the broader financial system and the broader economy? That's where I'm less concerned.
So you think there is, in a sense, even as we see more businesses going bust and more of these essentially private loans being written off, there is enough of a shock absorber within the system. This is not going to be a situation where, for example, it'll turn out that institutions that have a very direct material impact on all our prosperity, banks or insurance companies, are likely to be so damaged that their ability to essentially service the economy, make loans, provide credit themselves would be undermined. You're not worried about that?
No, that's not a chief concern. The fact that the banks have been, the upside of the banks having been so highly regulated for the last 15 years is the amount of capital they hold, the shape that the really important systemic financial institutions are in is fantastic. And therefore this infecting, I think I will go as far to say and boldly say, of course, you're always careful of your famous last words, but no, I don't think that's going to be the big problem for us in the next couple of years.
Karen, that's a suitably upbeat moment at which to draw this conversation to a close. As always, great to see you. Wonderful conversation. See you again soon.
Thank you for having me.
Goodbye.